Welcome to Financial Insights in Minutes, where we unravel today's most critical financial news in a snap.
Did you know that unemployment fears are rising as inflation continues to shake the economy?
That's right. Today, we'll explore varying insights from top financial experts, ensuring you're up to date with minimal time investment. We have a lineup of videos discussing gold predictions, unemployment forecasts, and the implications for our wallets.
It's a must-watch for anyone interested in staying ahead in today's volatile market.
Let's kick things off with the first video analysis. First, Game of Trades discusses how recession fears could be a bear trap, highlighting institutional investment strategies. Next, Eurodollar University explores rising unemployment predictions, backed by tumbling consumer confidence. Then, Trade Brigade shares essential trading strategies as key earnings reports loom, focusing on market behavior. In our fourth segment, Thoughtful Money welcomes Mike Shedlock to assess inflation realities amid CEO earnings reports. Fifth, John Cochrane discusses hyperinflation risks related to fiscal policies that could threaten economic stability. Gary Wagner returns on Kitco News, predicting gold could hit $2,600 this year based on current market dynamics. Ted Oakley from Oxbow Advisors warns about weakened consumer demand in retail impacting overall economic health. And finally, billionaire Marc presents his vision for a food delivery super app that blends quick service and quality dining. Welcome to Game of Trades, where we navigate through the stormy seas of the stock market. Today, we're diving into the recent spike in recession talk and market volatility. What's really happening beneath the surface?
That's right. The latest dip in stocks and soaring Google searches for recession have got everyone wondering. Let's get straight to the facts and see what's really affecting the S&P 500.
So what's the core idea here?
The main thesis is that while there's panic about a recession, the recovery of the stock market indicates that this panic might just be a bear trap. Institutional investors are buying the dips.
Let's explore those key points. What does the data tell us about these recession fears?
In August, searches for recession hit their highest levels since 2022. Plus, we saw a 10% drop in the stock market, only to bounce back shortly after.
So what was the reaction from the market?
Institutional investors seized the opportunity, buying $4 billion worth of stocks during the panic, while retail investors sold about $1 billion. Talk about divergent strategies.
Now, let's dig into that volatility index. What's going on there?
The VIX spiked to its highest since the pandemic, indicating serious investor panic. Historically, such spikes have often marked significant market bottoms. Time to buy instead of sell.
What does the future hold regarding interest rates?
With the Federal Reserve keeping interest rates high, we can expect volatility to persist for about 18 months. This means potential bumps in the road for the stock market ahead.
Any bold predictions for the S&P 500?
Absolutely. Many are eyeing a target of 6,000 points, especially if the current uptrend continues without major economic disasters.
Wrapping it up, what should viewers take away from today's discussion?
Stay patient. The most effective strategy might be to buy the dips as institutional investors are doing. What do you think? Will you stay bullish or bearish? Drop your thoughts in the comments.
Welcome to Eurodollar University. Today, we're diving into a pressing issue. Why are experts saying unemployment might soon skyrocket? Jeff Snyder is here to unravel the mystery.
Absolutely. Jeff's insights come from a deep understanding of consumer perceptions and macroeconomic signals. He has a knack for revealing the deeper truths behind the numbers, so hold on tight.
So, what's the crux of Jeff Snyder's argument here? Why should we pay attention?
The central thesis is that falling consumer confidence is a very strong indicator that unemployment is due to spike, contradicting the Fed's belief that the unemployment rate will remain stable.
Let's break down the key points, starting with consumer confidence. What do we know?
Well, the current conditions index has plummeted, showing a drop of 21.6 points since March. This indicates that consumers are increasingly pessimistic.
And what about those unemployment projections?
Historical data suggests that when consumer confidence declines, unemployment rises. Predictions are now indicating rates could soar to over 7% in the coming months.
Interesting. What's the media's take on these consumer sentiments?
The media tends to dismiss these feelings as mere whining. Yet, Historically, consumer sentiment has proven to be a better forecast than GDP numbers.
Let's talk predictions. What does Jeff foresee happening?
It looks like higher unemployment rates are on the horizon. Consumer confidence is falling, and historically, this has signaled bad news for job seekers.
Anything else to add about rising unemployment?
Yes. Continuous declining indicators in the market reinforce the narrative that we may be on the edge of an economic downturn.
As we wrap up, what are the main takeaways?
It's clear that watching consumer confidence provides critical insights into future unemployment trends. It's a reminder that everyday experiences can often reflect deeper economic truths.
Before we sign off, what do you think our audience should contemplate?
Definitely. We want to hear your thoughts. Comment below. How do you think unemployment will impact your community?
Welcome back to the Trade Brigade channel. Today we're diving into the action-packed insights from the live pre-market prep on August 20th.
That's right. It was an eventful grind day yesterday, and we have tons of market analytics to cover as we gear up for today's trades.
So, what's the meat of today's discussion? What's the framework we're working with?
The thesis revolves around spike rules, key principles traders use to assess market openings and subsequent price movements.
Let's discuss those key points, starting with market sentiment.
Exactly. Just yesterday, traders were encouraged to adopt a bullish viewpoint and recognize that the market was ready for upward momentum.
All right, so tell us about spike rules.
Spike rules help us determine how to trade effectively once the market opens. Depending on where it opens in relation to spike levels, the strategies vastly differ.
What economic indicators should our viewers keep an eye on?
Fed speeches are critical this week, especially ahead of the Jackson Hole Symposium. Unemployment claims will also provide significant insights into market movement.
And how does understanding market profiles benefit traders?
Market profiles create a visual representation of market sessions, helping traders identify crucial support and resistance levels effectively.
Last point, what are the key earnings to look out for?
Upcoming earnings releases from giants like Microsoft and Amazon this week could greatly influence market dynamics and trader decisions.
Now let's dive into predictions. What can we expect in post-market?
Anticipate market reactions depending on what the Fed officials share. Key moments to watch for.
And regarding stocks this week?
Post-earnings behavior will bring volatility. Traders should be ready for sharp movements.
So what's the concluding thought for our viewers?
As we wrap up, remember to implement spike rules, be mindful of Fed statements, and strategize around earnings volatility for optimal trading.
And what's that one question we want our viewers to think about?
What are your predictions for market reactions after this week's Fed announcements? Drop those thoughts in the comments.
Welcome to Thoughtful Money. Today, we're navigating the tumultuous currents of the market with insights from economist Mike Shedlock. Inflation has dropped, yet unemployment is on the rise. Could we be facing a significant recession?
Indeed. Mike Shedlock tracks macroeconomic data closely, and today he'll help us make sense of the numbers and what they mean for the future. Prepare for an insightful discussion.
So what's the main point that Mike Shedlock drives home in this discussion?
The core thesis is clear. While inflation is down, rising unemployment and consumer debt are ominous signs. Shedlock believes that we may already be in a recession despite optimistic headlines.
Let's break down those key points. What's happening with unemployment?
Shedlock highlights a troubling increasing unemployment rate at 4.3%, coupled with significant consumer debt that's particularly impacting younger generations.
Consumer debt sounds precarious. What are the specifics?
Yes, Mike emphasizes that credit card delinquencies are on the rise, signaling a consumer debt crisis that affects the market's stability.
And what's the status of the stock market?
Shedlock views the current market as overvalued, suggesting that negative economic indicators could prompt a market correction soon.
What about global factors? How's China playing into this?
Mike points out that a weak Chinese economy can influence global markets negatively, pushing us further toward a recession.
What does Shedlock predict for the market?
He suggests that due to excessive consumer debt and declining profits, a significant market correction is just around the corner.
And what about jobs?
Mike anticipates rising unemployment rates as businesses, especially small ones, start downsizing to cope with economic strains.
What should viewers take away from this discussion?
Shedlock urges everyone to stay informed and consider their financial futures wisely. Questions arise. Are you prepared for potential economic shifts? What steps are you taking?
What does Mike suggest regarding investments?
He suggests a cautious approach, as the markets could experience a steep drop. Viewers are encouraged to share their thoughts on future market trends.
Welcome to the channel. Let's dive right in to discuss the gripping topic of hyperinflation and its potential return. Today's guest is the insightful John Cochrane, Senior Fellow at Stanford's Hoover Institution.
Absolutely. John has his finger on the pulse of macroeconomic issues, with a wealth of knowledge from his work on fiscal policies and inflation theories.
What's the core thesis that John presents in this discussion?
The crux of the argument is that hyperinflation is fundamentally linked to inadequate fiscal policies. Even strong central banks cannot control inflation without sound government fiscal management.
Let's discuss some key points. Starting with fiscal policy, what does John emphasize?
John insists that without robust fiscal policies, hyperinflation cannot be contained. Governments printing excessive money to cover fiscal gaps creates the inflationary spiral.
What about the notion of price controls? Are they a viable solution?
John firmly states that price controls usually result in shortages. They create artificial prices that disrupt market functions, leading to even bigger problems.
What's John's view on inflation itself?
John points out that inflation should be understood as a decrease in currency value, which usually stems from fiscal mismanagement rather than greedy corporations.
What about long-term growth? What does John suggest?
John highlights a worrying trend. The U.S. growth rate has dropped significantly from 4% post-World War II to about 2% today. This low growth could fuel further economic instability.
Looking ahead, what does John predict?
He warns that without serious reforms, the U.S. government might indeed face hyperinflation, especially if unforeseen economic shocks occur.
What reforms does John believe are necessary?
He underscores the need for structural reforms in fiscal policies. Growth-oriented policies must be prioritized to stabilize the economy and ensure long-term stability.
As we wrap up, what's the main takeaway from John's insights?
The necessity for sound fiscal policies to combat inflation is critical. Viewers should consider the impact of government spending on their financial futures.
Have you got an opinion on how to best control inflation?
Absolutely. Drop your thoughts in the comments below. Let's stimulate some engaging discussions.
Welcome to Kitco News. Today we're diving into the booming gold and silver markets. We've got Gary Wagner, our resident expert, back on the show to unpack the latest charts and trends. Get ready for some serious market insights.
Absolutely. Gary's insights are always spot on. His technical analysis has a knack for predicting these precious metal movements. Let's get straight to the facts.
So, what's the big takeaway from Gary's analysis? What's truly driving the gold market?
The core thesis is clear. Gold is poised to climb, potentially reaching $2,600, as a combination of bullish market sentiment and favorable Federal Reserve actions support its rise.
What's been happening recently in the gold market?
Gold recently broke the $2,500 mark, reaching an all-time high of $2,511. Silver has been rising too, now over $29 per ounce, hinting at more to come.
What about the Federal Reserve's role in all of this?
The market is buzzing with optimism. A rate cut as soon as September is expected, shifting from a restrictive to an accommodative policy. This is a big driver for gold prices.
And what do the technical indicators say?
Moving averages showcase a strong bullish alignment. There's potential for gold to test $2,600 as trading remains in uncharted territory.
Gary mentioned something about wave theory. What's that all about?
Yes, he discussed that wave 3 could take gold to around $2,675 before a correction occurs. This is typical of the market psychology.
And what's happening with silver?
Silver is facing resistance around $30. Its industrial demand variety contributes to price fluctuations, which is different from gold.
All right, let's talk predictions. What is Gary forecasting for gold?
He predicts gold could soar past $2,600 this year, driven by favorable market conditions and potential rate cuts.
And what about silver? What's in the crystal ball?
Silver's performance largely depends on industrial demand. With supportive green energy policies, it's likely we could see it surpass $30.
To wrap this up, what should viewers take away from Gary's insights?
Overall, gold looks promising with potential breakthroughs, but keep an eye on Fed actions. What are your thoughts on gold's prospects? Drop a comment below.
Is there anything else to consider?
Absolutely. Anticipating market dynamics will be critical for both gold and silver moving forward. Let's navigate these waves together.
Welcome to Oxbow Advisors on YouTube. Today's topic is all about the retail earnings rolling in and what they reveal about the economy. Our guest is the insightful Ted Oakley, managing partner at Oxbow Advisors. Let's dive right in.
Ted brings years of expertise in investment strategies and market analysis. He's ready to unravel the numbers behind the headlines.
So what's the crux of Ted's message today?
The key thesis is that despite some companies beating earnings estimates, the overall retail atmosphere reflects weak consumer demand. Companies like Lowe's are experiencing substantial declines, hinting at broader economic troubles.
Let's dissect those key points. What's happening with retail performance?
Lowe's sales dropped more than expected, down 5.1%. This highlights a shaky demand in home improvement. It's a significant red flag.
What about consumer sentiment?
Indeed, 3 out of 5 workers believe they're already in a recession. Dissatisfaction with wages and benefits is growing, which correlates with decreased retail spending. It's a perfect storm.
Now, let's talk about investments. What strategies are being recommended?
Ted suggests shifting towards utilities and consumer staples, along with keeping bonds and REITs. These investments are more resilient during tough times. It's a smart move.
Any predictions on where we're headed?
Yes, weak retail sales are likely to persist, with corporate profit margins shrinking as companies deal with labor costs and economic pressures.
Wrapping things up, what should viewers take away?
Investors need to be cautious, focusing on resilient sectors like utilities and consumer staples. Remember, it's vital to monitor the macroeconomic indicators ahead.
Now here's a question for our viewers. Which economic sectors do you think will perform the best in the coming months?
Drop your thoughts in the comments. Let's hear your opinions.
Welcome to Public App on YouTube. Today, we're diving into the ingenious world of food delivery with billionaire entrepreneur Marc, CEO of Wonder Group.
Absolutely. With a background in transforming e-commerce, shares his vision for a food delivery super app, blending convenience and gourmet offerings. Buckle up.
What's the core thesis of Marc's vision?
Marc argues that by merging fast casual dining with meal kits into a single super app, consumers will receive personalized, convenient, and quality meal options.
Let's dig into the key points. What's happening with fast casual dining?
Marc highlights that fast casual dining is surging as consumers demand high-quality meals at fast food prices. This sector is evolving.
And what sets Wonder apart from other delivery apps?
Wonder combines fast casual and fine dining with options like Bobby Flay's Steakhouse and globally inspired cuisine.
What's the advantage of Wonder's vertical integration?
By controlling the entire process from cooking to delivery, they ensure optimum meal temperature and speed. Talk about fast food.
How is technology shaping Wonder's service?
Using AI, Wonder is tailoring meals based on customer habits and even sleep data via devices, optimizing both health and satisfaction.
And what about expansion?
They aim to establish 90 new locations centered around the New York metro area, effectively saturating demand.
Looking ahead, what predictions can we make?
The demand for convenient food solutions is only set to rise, and meal kits will likely flourish as well.
What else does the future hold?
Expect to see integration with grocery delivery and smart home tech, transforming meal planning forever.
What's the main takeaway from Marc's vision?
Marc is steering us toward a super app for meals, merging convenience and quality while improving our dining experience. Sounds appealing.
And how can viewers interact with this content?
Join the conversation. What features would you want in a food delivery app? Let us know in the comments.
Today we heard from Gary Wagner, who believes gold is set for a major upswing, and John Cochrane raised alarms about potential hyperinflation linked to fiscal policies.
Mike Shedlock highlighted the correlation between rising unemployment and consumer debt levels, while Ted Oakley expressed concern over low retail spending trends impacting the economy.
Despite their differing views, all agree on the pressing need for vigilant economic monitoring and sound fiscal management to navigate potential downturns and capitalize on opportunities. Thanks for watching Financial Insights in Minutes for August 20th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.